Um, yeah, thanks for joining, guys. Appreciate it. Uh, hopefully this isn't a complete waste of time for you. And um, I'll make it short and sweet. So I just want to like cover key points on the platform. So agenda for today is to run through in particular the indices page because I think a lot of you are futures traders like myself. Um, we're going to basically like how to use the indices page, what the different like pieces of the platform are showing you, how to trade them, how to like formulate your strategy around the data provided on the platform, how to like set up your plans, um, and essentially like trade more like a robot as opposed to a a monkey. And get out of like the monkey brain sort of style. Oh, this looks good. I'm gonna take this long type thing. And really using like the data that we have and the the probabilities that are like there, which we've built off of the data that we provide, which is only really going to be unique to us because everyone has like their own method of calculating certain outputs and so on. And so like this is basically like our model, our data with our own heuristics and assumptions that are built into how we produce certain things like levels that you see, where our positive positioning is, where our negative positioning is, and so on. So let me move on real quick to the indices page. Um, but before I do that, just a quick note for a couple of you guys who don't already look at this stuff. We have market notes posted every day, usually an hour before pre-market. This also kind of accompanies a morning session, an hour-ish before market open or cash open rather, just to be distinct. And what we do is like we run through various levels, which come off of the positioning, and then we basically describe like what we're seeing, uh, why why we think a certain way, what levels you should kind of like look out for, and so on, to kind of like identify an area that you want to particularly like go long or short, and what your buy should kind of be as and when we reach a certain point. Make sense? Cool. I assume it did. Um, yeah. So let's flip into the the dash. All right. So um, I said I'd go through the indices page, but just a very brief overview. As you've probably seen already on YouTube videos, if you wanted to look at an individual ticker, you have the options analytics page, that will basically give you the ticker that you're looking for with the various stats at the top, like the call by OI, put by OI. So like where is positioning like in terms of an OI basis on like the most active level, and then also by volume. I guess like the key difference is like OI typically represents situations where people are more likely to be writing, whereas volume is obviously like where transactions are happening type thing. Um, and then you've got like the GEX data, i.e. like what we're looking at is where is positioning from a market participant side, and how is that reflected on the market maker's book. So if it's negative, we're not saying negative in the sense of the typical textbook definition, which is negative gamma, which essentially means market makers are selling options. For us, that doesn't give you a lot of context in terms of direction. In fact, it doesn't at all, to be honest. Negative gamma just means that there's going to be more volatility. So it's kind of a defunct term, um, in terms of like making it actionable, right? But what we do is we look at notional or gamma notional on like a perspective of like, okay, where are participants trading? Are they trading more puts? Are they trading more calls? And then we reflect that in the book that the market makers are holding, and then that essentially lets you know whether or not there's positioning that is favored to one side, i.e., are participants looking for downside? Are they looking for upside expressed via options, right? So negative would suggest that positioning is on the put side, i.e., people are long puts, and then positive for us, that's unique to us because no one else does it this way. They go down the standard textbook definition of positive gamma essentially means that market makers are now buying options. Um, we look at it from the participant side, which we think is just more reflective and more actionable.
Hey, Doc. Sorry to interrupt.
Yeah.
Are you walking through the interface right now? And if so, can you share your screen?
Oh shit! Are you not see? Oh right, okay. It's on the recording, but fine. Sorry about that. I didn't
Appreciate it.
realize. I didn't realize I wasn't sharing my screen. Thanks for letting me know. Yeah. All right. Can you see my screen now?
Yeah, looking good.
Oh, thanks. Sorry about that. But this is what I was talking about before, market notes wise. So, just to quickly just reiterate the point, market notes are all in here. We have levels like listed out um, on the side, like from a bull perspective, bear perspective, on NQ and ES, because like we think they're the most important. And this is like a very brief synopsis, like kind of TLDR. I don't really want you to read paragraphs. I just want to give you a couple of notes, basically like what these indicators are saying, what that means, up or down type of scenario. Cool. All right, flipping over back to the options analytics page. So this is what I was talking about in terms of like GEX, right? Negative positioning essentially means people are long puts, and then positive positioning means people are long calls. And then on the DEX side, you've got the same thing again, where it's negative positioning from delta side, and then positive positioning once again is reflected in the positive DEX as well. Cool. You then also have like Varna and Charm. They hold importance for sure, and I argue that Varna definitely holds just as much importance as Gamma, and a lot of like the option gurus or like vol twit types will definitely like say the same thing. But what you're kind of like looking for with that is listed in the trading cheat sheet. Then essentially like the higher the Varna, the more volatility you're likely to see. And basically like from our perspective, what we're trying to demonstrate is like if Varna is positive as an example, but vol is crushing, then you're going to get a bid, and then reverse. If Varna is positive and vol is going up, then you're going to get uh, the reverse, right? You're going to start to dump type thing. And then in reverse, if Varna is negative, which isn't the case from a textbook standpoint, once again, what we're doing is we're trying to show the Greeks with some direction. So we've applied our own principles to basically just like say positive Varna is essentially looking at the call side, and then negative Varna is looking at the put side type thing. Make sense? And you've got the rule of thumb stuff on the trading cheat sheet. So you've got like context on historical numbers, how that then translates in terms of like a move type thing. Uh, and typically what we do is like we look at vol-based ETFs to kind of give us an idea of like okay where the direction is going. So like typically VIX, VOLI-VIX as a ratio, and then yeah, using that we then like basically determine how the moves are going to sort of play out. Charm is the same thing again. Charm is always negative if you hold a or your long vol, so whether that's long a call or a put, right? But that doesn't give you a sense of direction if you follow the textbook definition. So what we went and did is we basically said charm is negative if it's on the call side, um, i.e. your long calls, and then it's negative then because if you've got long calls, market makers are also buying to hedge the call that they've sold you. As a result, if that option begins to decay because the price is essentially stagnant, then what's going to happen is the probability of your position going in the money is going to decrease, and naturally then as a result the dynamic hedging that takes place essentially means they start to sell off what they're hedging with respect to your position, or their book rather. So that's why it's negative. To just make it really simple, like if you see negative charm and you've got stagnant price and nothing's happening, then that's gonna have a negative effect on price from a market maker perspective, because they're going to start to sell. And then the reverse again, with the put side, we assign charm as positive, because when puts decay, then you essentially get a bid, right? I hope that all makes sense. So it's not to be confused. Like, obviously, also at the same time, we are taking into account whether or not someone is long or short a put, because naturally then it would just be the reverse. Like if they're short puts, that's also going to be the same as a call, and naturally then you're going to have negative charm flows as a number. So that's all aggregated into one, to give you that. Cool. All right. And then like just before I like move on, very quickly, on the options analytics page, you have two sets of net delta profiles, net gamma profiles. And essentially what we're looking at here is where is positioning on a short-term basis for the first two expiries. So for SPY, it would be like the whatever the nearest one is, and then like the 3 days after, and then same thing again for the longer term positioning. So if it's on the gamma side, like what is that across the chain, like for everything, and then same thing again for the delta side. So you can get a view like how is positioning short term in comparison to long term, right? And then you've also got like open interest and volume, basically by like each expiry. Makes it easier to sort of understand like what's going on from that perspective, and you can essentially compare straight off the bat. And then you've also got the vol surface with vol model over here. We're going to change this, so this is going to get an update soon. Skewness, which isn't to be confused with natural skew. We have our own methodology of like identifying where demand is on the put side or the call side, and essentially like what you're looking for is a -50 for too many people on the put side, and +50 for too many people on the call side. That then like tells you like where you should kind of reverse or become a premium seller. Expected vol is just basically like the expected move calculation, and then you can see that how that pans out like on a daily, on a month, on a weekly, and then on a monthly basis for each tenor essentially. So like what is that group of options at that particular tenor kind of expecting in terms of volatility. And this is great for like just trying to identify ranges. So like you've just got the percentage there and basically saying like the options market expects this. Naturally you're going to have a bake in terms of an additional risk premium attached, which is natural for market makers. So it just gives you an idea of like, okay, if you're trading a range, this is the kind of range that you should expect, whether it's like from high to low and so on. You then also have like this daily distribution of returns, daily returns, weekly returns, and essentially like what you're looking at here again is just like a total view of how close to close returns are like on a daily basis and on a weekly basis. And this just gives you an idea of, okay, like on a week to week basis, on a close to close basis, just like as a very general term, how did SPY move on a given day, right? Any given day, and like what's the total list of returns? Because then that can really like temper down your expectations when you're trying to go short and you're near a hole, right? Like you've obviously got like the positioning and so on, but what you want to do is like also not be shorting when we're down 4%, like unless you've got a reason to, right? If there's like a complete narrative that would change that. So like an example here would be like daily returns. Like if we're down like 3% on ES or SPY on the day, looking at this, you know that there's a 1% chance in the total history of all returns that we end up lower. So are you going to play that probability? Like, probably not. Does it make sense? Like, you're playing against like history, right? And obviously, like, history doesn't necessarily always reflect the future, but it does a decent job. Um, and then same thing with the weekly side. Like, if you're trying to take a position and you're thinking, oh, okay, well, we've been up XYZ% during the week, we're up like 10%, right? If we're up 10%, well, you've got a 0.04% chance of going higher. So, like, do you want to play that odd? Like, are you going to start jumping into calls at the very end? Makes no sense to do so, right? Um, so yeah, it's all about just giving you a view from like a data perspective of like how or where you should position. Um, so you've got that data to hand, and then obviously like seasonality, which doesn't really need too much explanation, but just tells you whether we're going like bullish or bearish for a particular point in the week. I hope that made sense. Any questions on that? No? Okay, cool. Alright, so moving on, you then have the sectors positioning, and I'm going to flip between this page and the indices page because I look at both together. So, alright, so with the indices page, right, you essentially have everything that you had on the options analytics page, but just directly geared towards futures. So what is like the indices page even like showing you? First, you've got like a chart which is like pretty standard, just candlestick chart. Obviously it's like in our own colors, so the Navajo white is up and dark violet is down. And then you've got like these little lines, right? And these lines are basically giving you the positioning, but various densities signify like how prominent that particular level is. And it will always be relevant to like what you're seeing. So if you go down like a shorter time frame, different levels are then suddenly going to become more dense because they're relative to like what we're looking at, like what time frame we're looking at, right? So like this is a great example of like how do you use this information to like actionably trade. So and this is in American time. So we were trading at the end of the market yesterday at around 3878, right? Like we had like that peak, and then we had a drawdown. So like how do you even like look at this stuff and then identify like, do I want to go long or short? So here you've got this peak position right here, like it capped the move, and you can kind of see that like even this move that like pushed up above, we basically like pushed down below, right? And for like why does that even happen? Like what's the reason behind it? So just going back to like the market maker theory, if you know where a bunch of people are essentially long calls, right? Because that's what this position is, positive position. And if you want to flip between and see like, okay, where was said positioning at a given point in time on a historical basis, you can like see it all here, right? You've also got the annotations at the top to give you an idea of like where they're at. But okay, so we had this particular position here at 3908 at 9:55 on the 1st of November. I'm going to zoom back a bit and I'm going to go to that time point so you can actually see it. Okay, so we had that position here, right? We did actually like close above, right at the off, and then from there it started to kind of like drift down, and a lot of that is because of the fact that that peak position was a major positive position, right? And you can see that from a historical basis, like right here, it's insanely high in comparison to everything else. So when you've got that particular position basically like screaming higher, right? And then it starts to decay. You know people are starting to pull out of that position. When they're starting to pull out of that position, what's going to happen? Like from a logical perspective, they're either rolling that position, that option, to another date at a higher strike, right? or alternatively, they're just taking profit, in particular if it's a short dated position, or alternatively, they are staying at the same strike and then they decide to go long that same strike at a further tenor, which may not make sense. So ideally, it's the first two options. If a bunch of people who are at that position and they're trying to get out of the position, right? Market makers are then going to be in a net sell mode, effectively, right? Unless the other positions above, calls at higher strikes are increasing and they're out in further tenors as well, market makers no longer need to hedge with respect to that 3908 position. So then they start to sell, and then you just get this net sell effect that occurs. And naturally, when that happens, you then have this huge flow coming in from market makers that will like be pretty much visible on tape. Like you're able to see like these block orders that are coming in, and they're starting to sell. When that happens, then naturally you're going to get the sell effect. So you literally just use these strikes to basically identify like where you want to be short, and then above that you can even see like the 3918 position, right? And then above that you also had 3930, but you knew that wasn't as large. So your main position here, just like from a density perspective, is this 3908 one. Like you know that's the largest position where we're trading at because of how much brighter it is relative to 3918. And then 3938 is like hardly anything on it. So if there's less positioning up there, which means that there's going to be less buy pressure, then ultimately it's going to fade. And you can see that in the candles, like it was wicky, like right as we got there. And then when did it really like wick down was right at this position here, and that also kind of coincided with positioning starting to pull down. Make sense? Cool. All right. Assume it did. All right. So like another thing, how do you know as well to like use as confluence? How do you know if being short or being long is the right thing to do at said position, right? So if we look at the volas over here, they weren't really showing a bid signal here, right? There was just no bid being shown. It was just essentially flat, or albeit if anything, like no major divergence in terms of like a sell, but they definitely weren't showing a bid. So like you kind of have another signal to not give you confidence in being long, right? So you have two things there. You've got the positioning, you have the volas not agreeing with it, and then on top of that, you also had like a real like lack of volume at that particular point, like especially for that particular open. Like it wasn't really like majorly spiking, and at the same time, one of the other things that's kind of like even more prominent is, and this is what I like to use, if I see a spike in volume and price isn't going up or it isn't going down and it's kind of like stagnant, that's telling me that there's absorption going on. And when absorption's happening, usually what happens then is you get a reversal in trend. So similar kind of thing right over here. You had the volas basically signaling a sell. Wasn't a great example because we didn't really get any major sell here, but when we did reach this position on the market maker level side, which you can see over here at 3878, that capped this like little consolidation phase. You could have taken a short here a bunch of times, taken a short here, taken around 3878 to 3867, that's 11 points, and then wait for it again, comes up again, you barely like had a peak above, you took about 3 points MAE, and then after that you took another short, you then had another, what's that over there, let's see, around another 9 points, could have taken another one, another short here again at the same position, using the levels, highest this time that gave you 5-point MAE, but then you got a real dip, right? So yeah, it's like a just another example of like how to use it. Uh, and then like another one is like kind of going into like the latter half of the day. Obviously, this is like the FOMC. So looking at this here, you had the volas basically signal to be long as well, right? Like they were already starting to like pick up at this point. Like they were low over here, but they'd already started to pick up. You had this crossover, divergence really started. It wasn't as big, so it wasn't a textbook definition, but the divergence kicked off. You had a negative level right here, right? Could have taken along there at 3838. Um, had a brief look below. I think we hit 3833. Small bounce, so -5 MAE. Maybe you give yourself 7 points to just like take the hit. You literally could have made, if you held, like maybe you had a couple, leave a runner on, take at least like 10 points up to 3848, and then after that you just let one run. So you've got a free position, you don't actually care what happens. And if you did do that, then you absolutely banked. Like you made 100 points, day done, don't need to do anything, sorted, right? Let's say you missed the move, but then you wanted to like get in somewhere after. Was like, okay, FOMC days are obviously always crazy, but if you were like in voice chat, we had FOMC basically like streaming at the same time, listening to what Power was saying. So he's super hawkish. Then I'm only thinking, all right, there's so much vol. Like, where do I even jump in? Like, where's my position gonna be? So you had this like peak above. Uh, you have this 3908 position like right here. So you know to be like fairly short necessarily like around that sort of point, right? Like 3900, 3908. That's kind of where you want to like be short. We literally tagged it and then we just completely dumped. Um, so that's like another great example of like where you could just use positioning to really like signal for a reversal, especially in like events like this, because like otherwise it's really difficult to like just identify. Okay, either using volume profile or you're using um, these market maker positioning levels to like basically just figure out where you want to be short, where you want to be long. I hope that makes sense. And then I guess like the other part is like, okay, I'm looking at all of this, fine. How do I know where positioning is? Like, where do I need to be looking on a historical basis? Well, you've got the same thing here. Like right here at 926, like even prior to FOMC, you had all this positive positioning, like relative to the negative side. Um, like right here, this was 3858 rolling off on the positive side. You had positioning on the negative side growing at 936, right? And if we go to the timing, negative positioning was growing, positive positioning was pulling up. That's like a great time to like, think about just doing the opposite, right? So 926, it just completely cratered. But negative positioning actually grew in that period. So I hope that kind of makes sense as well. And then like also like if you're looking to like take the reversals, like here's another one, 3818. We had a pull down right to 3818. Positioning was here. You had negative positioning here. Take along, you took about on the lowest, you took about 6 points MAE for about a 30-point move. But I mean, obviously, it's all easier said than done in retrospect. Like everything looks easier in retrospect, but it's a case of just like building the conviction for like when these moments arrive, and when they do arrive, just like trading systematically, because that's the only real way you become kind of profitable. Cool. Um, and then like the other part is also just like okay, well you've got this, and this is going to get merged into the stock chart, so it's just even easier to see. But you've got net positioning like overall here. So this is including like the three major indices: Rusty, Qs, SPY. I'm basically looking at like where is their positioning going? Like, is it going up? Is it going down? Like, where am I looking in terms of like how that positioning is starting to like move, right? This was 9:30. At 9:30 we had a big dump going into 9:35. So positioning was actually like was pulling down. So you have this live positioning tracked every 5 minutes, right? Updating consistently and then telling you like where we're going in terms of up or down essentially. So let's like go and correlate that over to time frames. So this was the day prior. 9:27 was we had that like down candle. If you look at the same timing over here, just prior to that, you knew that positioning was starting to pull down. So there was just an increase in negative positioning. So you could use that to like just forward guide where you're going to go with price because you know that option markets are getting more bearish. Naturally, then as a result, market makers are going to be selling. If the biggest fish in the pond is selling, then you want to be doing what they're doing as well, right? And if price is going against it, well then you should also be thinking about, do I want to be in this long position? Probably not. Like maybe I should reassess, or I want to get in and out like very quickly and then move on. The other thing as well is like skew. Skew is great to look at to trade type thing. So okay, giving some context, we had positioning at 9:36, basically like at nothing, right? Like no real negative apart from Rusty, which was like -50. We then blew out at 9:41 to -118, and we stayed at around this level after. So 9:41, we're going into today's positioning. Alright, here we go. So 9:41, we had a pull down, and that landed us to a low of around like 3844 from 9:41. Where was that read? That took us to a low of like 3848. So, alright, you took 4 points MAE, right? 4 points MAE to then potentially land 3854. So let's say you took it right at that 3848 position, right? You took 6 points, you had 4 points ME. So like you still managed to like gain some points there. It's not like an amazing risk reward, right? You're only like 1.5. That's still okay. It's not too risk reward, but you then had that. Maybe you like took to get a bit more aggressive. You took another like position at 3844, just like add whether it was ES or MES or whatever you like size your account is type thing. Then you also know at the same time positioning starting to pull up, right? So then that should just give you more confidence. Like, okay, well look, I'm here. Positioning is still kind of like pulling down, but bang, like right this at 11:05, like positioning starting to pull up again. I'm gonna try and take this long, and that lines up pretty much with like where positioning started to push up, right? Same thing again. So it's just a case of just like systematically like just following what is there in front of you, um, lining them all up together, and then identifying how positioning is moving. Like even on the delta side, like we have this loaded intraday. You can see where positioning is going, where it was like majorly positive, where it was negative. This is telling you like how the markets are moving. If we look at timing, 11:31, again, like looking at intraday positioning, because you have it both for the deltas, you have it for overall flow, and then you've also got it on like an individual basis. Maybe you want to just focus on one because you're looking at ES instead of NQ, right? 11:31, we were here, so we're like sort of just bouncing up, meandering. 11:47, we started pulling down. 11:47 on total flow, was basically when it started to like pull back down again, right? So 11:15 we started to pull down. It wasn't a lot. 11:30 we went from -4 to, by 11:55, -5 billion, right? So that's a 20% increase, or -20% if you're looking at it that way, in positioning. So it's just another way of like using positioning to just identify like, okay, should I be short or long here? Like what can give me confidence? Because that's all it's ever about. Like, you're pulling the trigger, you just need to know like, am I right or wrong? So using the positioning, you can identify that. And then the same thing you can see like even on the delta side, like the delta side is showing you exactly the same thing. This is pushing up, so that's kind of going against what is being shown on the gamma side. But you see like gamma's a lot more sensitive. Delta wise, you can see like a peak happen at around 12 o'clock on SPY, and when you look at 12 o'clock here, that's basically like the top. Like we just didn't, we got out of this little zone and we started pulling down again. So you then had another 10 points to take, right? And then it just continued lower. So it was like, okay, well, here's a clue. People are actually still trying to get deeper and deeper into negative positions heading into FOMC. Like they were piling into those positions way before. So we got the vol crush, like there was a bit of vol crush, naturally as expected, right? And you can see that across the board. Like even here with positioning overall, just before, which naturally happened, but then like they still were piling in. So it's like, okay, you're hearing all this stuff on the presser, there's wacky movements happening. All right, I have these positions level wise. Where do I need to just limit order and just walk away? Um, yeah, I hope that all kind of makes sense, and that's like, I think today was like actually a really good case study for like how to use platform. One of the other things that I just want to really quickly run through is this this bit here, like these little shadow prints that pop up, right? So they don't necessarily appear on futures, but when you look at the indices, like on the ETF basis, and then you correlate those positions to futures, you get these levels that just don't appear otherwise. And like typically, what we've seen is like in the past when that's happened, they've been indicative of a move, and this is like a great example of it. So the fact that this is like pushing up makes me think that there is potential for like another little like wiki move higher. Obviously, like we'll keep watching positioning, seeing how sectors change and gamma changes and stuff like that, and also just review overnight session. Um, yeah, I think that kind of like covers for this like Vex boarding session what I wanted to look at. So it's recorded. It will be up on YouTube if you want to go and re look at it again. Feel free to. We'll consistently keep updating the pages to give you that view. That makes it even easier to like sort of just understand and watch. Um, but yeah, all right. I am gonna stop the recording.